So we've already heard some headlines out of the prepared remarks from Randy Quarles, and he will particularly say that there's work left to be done in improving banking regulation, that he particularly is focusing on capital ratios for some of the community banks. What are you looking to hear from him? What do you want to hear from Randy Quarles?
Well, the first thing I hope I hear is that this isn't it. This isn't the end game. So I view what the Fed has done with their proposed rules to be progress, but progress is not to be confused with success. So number one, I'm very happy that the Senate and House got together to pass the Economic Growth Regulatory Relief Act. Otherwise, we wouldn't be here in the first place. It allows many banks, particularly our community banks, to escape the worst of Dodd-Frank. So I know that Vice Chairman Quarles has set out a goal of transparency, efficiency, and simplicity. Again, I think he's made some progress, but we're not there with success. I mean, the Volcker Rule is still very convoluted. I think that, again, we have historic levels of volatility and illiquidity that will serve us ill should we have times of market stress. And unfortunately, I think that the Fed could have done a whole lot more with their other prudential regulators in trying to simplify the Volcker Rule. That's number one. Number two, I still don't understand why we have a qualitative aspect and not just a quantitative aspect to CCAR and DFAST, the stress test. I think that leaves way too much discretionary power in the hands of regulators, and I want to understand, why is that still there? They dropped it for one tier of banks, but they kept it in for three. And so there's a number of questions. Again, I think it was a good first step, but if it's the only step, it's kind of thin gruel. It doesn't quite get us where we need to go to ultimately help us sustain a 3.5%, perhaps 4% economy.
So it takes us to the core of the question. How much of it is up to the discretion of the Federal Reserve and other regulators, consistent with the statutes, and how much of it needs to be changed statutorily?
Well, again, we just went through this exercise, and the House passed a far more robust bill in the Financial Choice Act than the Senate was able to pass. Again, the Senate is not a majoritarian institution. They passed what they could. They needed 60 votes. So I would like for there to be more statutes passed, but given that the House just fell into Democratic hands, I'm not exactly holding my breath. So most of the action is going to be on the regulatory side. And let's face it, Dodd-Frank gave incredible amounts of discretionary power to our regulators, and there's much more they could do that would still adequately police for systemic risk, but help facilitate capital formation and intermediation that they haven't done yet. And so again, I just think there's so much more work to do on the Volcker Rule. You know, covered funds, for example. I don't understand why a bank, if can invest their money in a certain investment, but if they do it in a pool, they can't. That doesn't make a whole lot of sense. So there's a whole lot more work to be done. They're somewhat limited in what they can do with Volcker, because they're going to have to get buy-in from the other prudential regulators. But that thing has just been kind of a scourge, and again, will serve us ill in stressful times.
So let's talk about that scourge, because we have a question here from a viewer, actually, on the Bloomberg, who says, please ask why the Republicans continue to lean on the Fed to reverse the Volcker, he says act, I think he means rule, as the economy is slowing. Is this the right time to be backing off the Volcker Rule?
Well, I don't think there's ever a bad time. Again, Volcker, if you look at the rule, proprietary trading had nothing to do with the financial crisis. And in fact, if you look at the institutions that were more diversified, they weathered the storm better than many other institutions. And so in many respects, I viewed it as something that was simply thrown in at the last second to be punitive to certain banks. But it was not core to, again, to the crisis, and it's led to incredible amounts. Even the Fed admits that it is a contributing factor to illiquidity and volatility in our fixed income markets. This is not a good thing for our economy. And again, for the third time, in a stressful economic period, this could really exacerbate economic problems.
So finally, Mr. Chairman, you're stepping down. First of all, you were term limited on your chairmanship, as I understand, and you're stepping away from the Congress. It's a good time to ask you what you think about the independence of the Fed. I'm sure you're for the independence of the Fed, but what do you make of President Trump's really apparently trying to jawbone, as it were, the Fed into not raising rates? Is that appropriate? Is that constructive for the president?
Listen, I think it's kind of a silly argument myself. I mean, last I looked, governors of the Fed have 14-year terms. They write their own budgets. We want an independent Fed, but they also have to be able to have a skin thick enough to take a little criticism. So I don't feel a need to comment on every FOMC meeting, but if the president does, so be it. I wasn't elected president, he was, but in somehow believing that this is going to somehow compromise their independence, I say a bunch of hooey on that. I would say to the president, if he asked my advice, you better be careful because they may push back and push the other way, and it may not have the intended effect. But the Fed ought to be able to listen to lots of feedback, critical feedback and criticism, including that of the President of the United States. Doesn't impinge upon their independence one whit.
So not to deal with the hooey, as you say it, but on the merits, do you think the Fed is right to continue on a rate hiking path?
Well, I want us to get to a neutral rate. I want us to have market-based rates. I think that the Fed's footprint in the economy has been much too big. I can quibble over the pace. I can quibble over the ultimate destination, but I at least think in general I've agreed with the trajectory. I've agreed with the goal of getting to a neutral rate, and I kind of think we're either there or we're about to get there, in my opinion. But again, the general trajectory, it's not going to be easy to unwind the largest, monetary policy stimulus in our nation's economy. Particularly where the Fed invested in MBS and mortgage-backed securities. I mean, we have an incredibly large balance sheet. We have a balance sheet that should be treasuries only, that isn't, that can lead the Fed getting involved in credit allocation. And it's been left to Chairman Powell and his cohorts to really unwind this whole historic experiment in quantitative easing, and we still don't know how it's going to end. It's a tough task that they have.